Here with more on the currency market is Daragh Maher. He is Deputy Global Head of FX Strategy for Credit Agricole. Thanks so much for joining us, Daragh. How closely do you think Jean-Claude Trichet and the rest of those policymakers in Europe are keeping an eye on what's going on in commodities?
Yeah, I think they'll be very mindful. I mean, obviously, this has been one of the key drivers to inflation, the pickup in food and energy prices. I imagine they'll very much welcome any retracement. Obviously, they'd prefer it to be orderly. But nonetheless, this will be very pertinent in terms of their inflation projections and therefore what they need to do with interest rates.
We've seen the euro move from $1.49 yesterday to as low as $1.44 earlier today. So it's been a very volatile few days. How much is the commodities trade driven by, or how much is the FX trade driven by what's going on in commodities rather than fundamental issues like interest rate expectations?
Yeah, I still think interest rate expectations have been kind of the dominant driver. If you look at the dollar index, for example, over the last month or so, its correlation has been much stronger with interest rate expectations than it has been with movements in the oil price or other commodity markets. So I suspect that big price move that you described in euro dollar, 149, just beneath 145, was largely a function of A, the market being too long in euro, and B, Trichet perhaps not being quite as hawkish as euro bulls would have hoped for. Alongside that, in parallel, we had the retracement in commodities, which gave an extra boost to the dollar. But I think at its core, this was really an ECB reaction rather than necessarily an echo of what was happening in the commodity market.
Right. The market being too long on the euro, how much are they pricing in terms of tightening in Europe?
Still looking towards 50 basis points over the course of the year, which looks, ballpark about appropriate. Trichet didn't flag a June hike, July, so we're kind of moving once every 3 months, so that feels kind of neat. Obviously, if oil prices retrace, I think the markets will be more comfortable about that view. The risk is if oil pushes up higher, that the ECB might have to get more hawkish again.
How is the picture different in the UK? We had manufacturing numbers that suggested that the Bank of England shouldn't be in any rush to raise rates there.
Yeah, I mean, we've certainly had softer numbers across the UK. You mentioned manufacturing. You've had some softer retail surveys as well. And there is a sense that the inflation that we've had in the UK has put a big squeeze on consumer spending. Bank of England, though, the reaction function seems very different to the ECB's. They're more concerned about the growth uncertainty. They still point to high unemployment, low credit growth, etc. So they seem to be on a different trajectory. Of course, from a foreign exchange perspective, that means sterling stays on the defensive against the more hawkish ECB.
Where will the surprise then in relative interest rate expectations come from in this world?
Well, I guess one potential source is the Fed. I mean, there's a general expectation that the Fed will be on hold ad infinitum well into 2012, but, they also have this very big balance sheet to address, and, if there's any hint at all that perhaps that adjustment is going to come sooner than the market's expecting, that will have a profound effect on the dollar and currency markets in general, asset markets, in fact, in general. So I suspect that's the greatest potential source of surprise, but at the moment, and Brennan, we heard last week, they don't seem to be moving in that direction.
Right. We did have one Fed official say earlier today that it would be desirable to have higher interest rates, but Ben Bernanke has made very clear his stance. All right. Thank you so much for your time. Daragh Maher of Credit Agricole joining us from London.